and this is the weekly commodities and precious metals video. I guess the main event was the end of last week, where we saw the non-farm payrolls come at about minus 30,000. Would normally be a shocking figure, but the market completely disregarded that as being influenced by the various hurricanes that have hit the southern part of the United States. And we saw very, very good data all through last week, including average hourly earnings, all these good things that were pointing towards the Fed being on track for another rate hike this year. In fact, the data last week, apart from the non-farms, was nothing short of fantastic. I guess this means that the US dollar itself has been relatively strong into the end of last week and into the beginning of this week, and there's no reason we feel that that correction won't have more legs. So what does this mean for precious metals and commodities? Well, let's just dive straight into it. Here we are with the gold chart. It's been an interesting few days for gold. It got marked down on Thursday on a generally stronger dollar. We touched 1260. We broke through the 61.8% retracement at 1262, but interestingly, we didn't close below it. In fact, we made a storming comeback as saber rattling and geopolitical tension started running around the world again with Iran and the North Korean or the Korean Peninsula. And as we run into the start of the week, we've seen that trend continue. This is actually a semi-bullish turn of events, to be honest. We have broken back above this red line, the 100-day moving average, which was sitting at 1274-ish today. And we are now having another look at this 1291 level, and of course the original breakout to the top side, which is around 1296. Downstairs clearly now, this 1260 region, the low of the spike low of Friday is pretty key support, followed by the 200-day moving average at 1254. Gold has actually rallied, I must say, mainly on geopolitical events, despite the fact that US yields have been sideways, stocks have been at all-time highs again, and the US dollar's generally been stronger. The key to this will be, once those geopolitical noises die down, whether gold can actually manage to sustain this sort of nascent recovery in its prices. And it's perhaps just a little bit too soon to make that call. But in the meantime, with China back from holiday after being out all last week, we have seen regular physical demand each morning in Asia. We are definitely having a look at this we are definitely eyeing this 1296 region. If we pop over to silver, I sort of feel silver actually led this move, to be honest. The recovery, it sort of telegraphed it ahead of time. In fact, we can see here this green line here, the 50% retracement, the Fibonacci level that I talked about last week. All of last week, except for Friday, we actually closed just above this line at around 16.57. So silver has actually pulled back into this Fibonacci retracement box, the 38.2 and the 50%, which is where I would have expected it to base after this very, very long run up from July in order to start looking back towards the top side again if you were bullish on silver. The fact that we've flirted with it, and then actually what we did on Friday, we had a spike down, which I suspect was stop losses after this level broke. And then we've immediately made a new high and closed to that high, which was an outside reversal day. So we made a new low and then a new high. We've then moved directly higher after that through Monday and Tuesday and broken back above the 100-day moving average, which I take as a fairly bullish technical sign, to be honest. It's hard to look at it any other way. For now, it doesn't suffer quite the same geopolitical to's and fro's that affect gold, but certainly now it would indicate that we are going to attest this 200-day moving average, which is around 17.17. After that, we end up retesting the highs of around the 20th of September, which is sitting around 17.40. But if we actually do manage to move up into this region here and consolidate, having retraced into this Fibonacci retracement box, as I call it, that would be a very positive sign. And maybe silver is the one that's signaling to us that perhaps the worst is over for now on the precious metal pullback. The ugliest horse in the glue factory, of course, has been platinum, as we can see from this chart. And again, as I spoke about last week, we were at very, very oversold conditions. If we look at the very bottom right-hand side of the chart, the RSI was extremely oversold. We have tested this 90385 support line, bounced off it. Again, you could almost construe that as an outside reversal day, very similar to silver. But the rally after that has been more muted. So looking at this technical picture, we still haven't managed to regain 927.60. I think perhaps it's a little too soon to call a base in platinum, given that it has actually almost retraced nearly 100% of this rally from July to September. It does bear watching, and perhaps now it will also perhaps give a leading signal ahead of gold as to how precious metals do. But we definitely need to get above this 927.60. After that, we run into this 946 region, which is also home to the 100-day moving average, which is in the same area at 947. This juicy double top here around 946. 947 is a very key resistance area now. On the downside, the must-hold level is, of course, this 890, which was the low in sort of around early July. So this is a must-hold level now. And that would invalidate any sort of bounces if we were to get some daily closes below it. Palladium, the metal that just keeps giving. Again, we can see, looking at if we squish this chart up, really the pullback that Palladium has had has been very minor indeed in the scale of the uptrend that we have seen since last year. So we must be 15 months into this rally now. I guess you could say this is a sideways consolidation. It has had its pullback. I mean, it came back from 1,000, which is clearly an important level now. We'll call that actually a little higher. What's that got there? 1,001.75 is our obvious immediate resistance, followed by this 947 region. We do seem to be consolidating now between sort of 907 and 947. We've been in the sideways consolidation really back into almost late August now. Hard to sort of pick holes in this. I mean, the rally's been stupendous, and it does look on a longer term basis that we're seeing consolidations move up, consolidation move up, and maybe this is pointing towards the same way. The 100-day moving average will be a key level at 889.60, and then we have this very long-term trend line support. If we just extend this out today, and this is coming in at around the sort of 852 region. If we're honest with ourselves, we've come nowhere near testing this level at all, and it's very hard to get technically bearish on Palladium at this stage until we see this line well and truly broken, and probably taking out the 200 as well. Let's move over to copper. Perhaps trading was a bit muted here with China away last week. I did say that we may have had an incipient head and shoulders formation. I've left this up simply because it's good to see when things go wrong as well. So this actual formation is invalidated now with this spike out on Thursday night to the top side. We broke this 297 resistance level. So this formation now is invalidated. We do have resistance now at today's highs around 304, and then it'll be this sort of 306 region. But really the level it will need to take out is this high around the 315 area will be the next key resistance region. Downstairs, if we were to move this, we have a series of daily lows around excuse me, 284.70. If I just move this line up a little bit, we do have a series of daily lows also around the 286.5 level. So we do have a bit of a support region around here before we hit the 100-day moving average. Really, it has been a sort of a quick rally consolidation and then rally again pattern to copper as the world's economic data recovers and all is good and great, excuse me, in China. So I guess this is actually more of a reflection of the health of the world economy. If that's how you're looking at it, rather than any particular change in the supply demand setup for copper. Let's head over to some of the energies. Natural gas continues to be one of the most, probably one of the most dull charts, to be honest, that we have on the weekly. Again, it's still consolidating in this range, moving now back down towards the bottom of the range. But to be honest, when we look at this sort of rectangle pattern here, with the exception of these 3 days here of the false break, we really aren't seeing anything at all in the natural gas setup to suggest that we're heading for a big move one way or the other. It is interesting that as we head out of the end of summer towards winter in the States, when you would sort of think that that maybe natural gas would become more in demand as we need heating, etc., and they'll be stockpiling it, that we are trading towards the bottom of this range. But I think until we see either a break of this 275.50 area or this 3.107 310.70 region, it's hard to say that it's in anything but a giant sort of long-term range trade at the moment. Things are rather more frisky though over in Brent and WTI, if I could just spell it correctly. And again, we can see from this, just to give some perspective here, everyone, about the Brent rally. Now, as you know, I've been constructively bullish on Brent simply because the front end futures, amongst other things, have been in backwardation, where the prompt futures, the short end futures, are trading at a discount to the spot price. This is meaning that people are more desperate to buy crude, Brent crude in the short term, pushing up prices, and not so much in the further out. So this immediate delivery is a very structural bullish sign in the market, and it hasn't been like that for many years. When we put this into perspective and we look at the long-term uptrend line here, this support line, this diagonal green line, we can see that even with the pullback from 59 all the way back down to sort of the early 55s, that we still have come nowhere near yet testing this long-term support line. Until we see this long-term support line broken, if we could think back to the Palladium chart, it's a very similar sort of setup in a way. Until we can see this tested and broken and some consolidation underneath it, it's just a little hard to turn bearish on Brent crude on a long-term basis. We have some support around 53.5 and sort of the 52.70 region, a series of consolidations and previous highs and lows. And then the 200-day moving average around 52.35. Clearly on top we have a almost double top here at 57.40. Let's pop a line in there, shall we, and make that one just a little bit more obvious. Around here, so I mean, it's topped out here twice, and that was late last week. We do have perhaps some less hurricane distorted crude inventories, etc., coming out this week. And that'll give us a better idea of the state of the US. This has a much higher delta to OPEC and OPEC, and there's been a lot of noise from last week when the Saudi king was visiting Moscow that they were agreeing that they were going to extend the production cut through all of 2018, and that was that spike. We can see here up to the 57.40, and then they were backpedaling just as quickly the next day, and that was that drop off. And then over the last couple of days, there has been noises from the OPEC Secretary General ahead of the November 30th meeting that they want to nail down some sort of agreement with OPEC and OPEC and the non-participating members, i.e. Libya and Nigeria, with regards to a production cut ceiling to go forward with. So that may keep a bit of a floor under Brent crude for now. West Texas Intermediate, WTI, obviously a much higher delta towards the US refining, etc. Funnily enough, with Hurricane Nate over the weekend shutting down most of the Gulf's production and most of the refining capacity in that part of the world, the actual rally was pretty muted, to be honest, with that one. We've got maybe 70 cents out of that from over the weekend following that OPEC Russia backpedaling on Friday, which doesn't fill me with a huge amount of confidence in the short term, and it may well be that US refining recovers and shale keeps pumping like mad, and perhaps that big discount that WTI is trading at to Brent means that the price action will be more muted. We may also be seeing a lot of shale producers now hedging production, i.e. selling futures on any pop-up above 50, and that would also take the heat out of any speculative longs. To put it in context, this is the big long-term resistance region up on the top left-hand corner, this grey box that sits between sort of 53.50 and 54.70. We really need to see WTI consolidating above this box in the longer term before we start getting super excited about $60 oil on the WTI side. Below here we have the 200-day moving average, which will be short-term support around 49.20, and then a break of this 48.80 region would almost certainly imply that we have a run down to this 47.5 100-day moving average. It just seems for now that the supply metrics for the US are conspiring now to keep a lid on WTI. Let's head to some of the softs now. Apparently, hedge funds increased their short positions in agriculturals in the Commitment to Traders report last week, so they're returning to selling agricultural commodities. It's not really reflected in the price action, to be honest. And when we look at sugar, and it was a very sort of low-key week actually for most agriculturals. There was a report put out saying that the sugar harvest was going to be globally much higher than predicted this year, but that's really not had too much of an impact on sugar itself. A bit like natural gas, it still seems to be consolidating in a very long-term sort of rectangle, with the top at around 0.15, $15 a pound, 15 cents a pound, sorry, and 12.5 cents a pound on the downside. So 15.0, 12.5, and until we break out of those regions, those levels, it's hard to start getting too excited about those artery hardening commodities we're looking at here. I will due note though that it has failed at the 100-day moving average, the sloping red line, over the last few weeks, and we've seen a couple of tests up here but no closes above it since it broke down, what would that be, about late September. This implies to me at the moment that if we were to break back above it and have a daily close above it, then it would be a pivot region, and we may see a sort of a grind high towards the top of that range trading zone. Let's go over to the soybeans. Again, it still looks to me like it's getting ready for a big breakout. We did have a bit of a false move there, if I just extend this line out, yesterday. Bear in mind that yesterday, though, the United States was actually closed for trading, and so for me, I don't put too much store on the price action necessarily on those days because it's very, very thin. We did hold the 200-day moving average as well, which is this line that comes, this blue line at 973.40. So we've popped up through this sloping triangle and then closed below it. We have actually consolidated today before the US really gets cracking. These two levels here seem to be pretty much denoted now by the 100 and 200-day moving averages. 100-day being just below here, the red line at 953, and then we have above here, the top of the line is around 971, and the 200-day is just lurking above that at 973. It does look like it's getting set for quite a substantial breakout from a technical point of view, but it's still indeterminate yet as to which way that break will be. But the triangle is symmetrical and it is closing very rapidly. So definitely keep an eye on that. And a couple of daily closes outside of that could signal we have a substantial move on our hands at last. The corn, slightly disappointing to me, to be honest. I did get excited about that, as viewers will know. We have broken out of the symmetrical triangle in textbook fashion, and we have consolidated. We did try and move higher, but we did fail at around this previous high here in early September, which is at 347.50. And since then, we've drifted back and we're trading sideways. I don't have any specific reasoning for that. All I can say to you is that this technical picture now is pretty much become invalidated, and we are looking like we are now moving back into, if we were to take these off actually, just to show you, we're definitely moving back into a consolidating range trade again. 347.50, 329.50. We're sitting solidly mid-range now. Little hard to get excited about corn at the moment, although if you are a range trader, these are great markets to trade with a little bit of patience. But yes, unfortunately it does look like corn will be quiet for a while. Let's wrap it up with wheat. Again, a bit like the rest of the commodities this week, it's very, very quiet. It's sitting in a range as well. And to be honest, until we can see this 349 region, 439 region on the top side, or this 393.70 region break on the downside, just a little hard to get excited about the agriculturals at the moment. I do note that this blue line here, the 200-day moving average, again, it's broken down through that and not managed to regain it. So maybe we are due for perhaps a bit of a drift down towards the lower end of the range. Clearly it will act as an intraday pivot, so that if it was to break that on a daily basis, it would imply that we move back towards the top side of the range. But it does appear to be steady as she goes. Behind the top side of this range, we do have the 100-day moving average at 441 as well. So definitely wood to chop on the top side anyway. The 200 resistance, excuse me, and the 100-day moving average. So it looks like we're in a holding pattern there on the commodities, on the agriculturals at the moment. Well, that wraps it all up. Thank you very much for watching. I hope and trust that you got something useful out of it. I'm sort of sorry that the markets on the agriculturals in particular aren't too busy this week, but I'm sure we'll get some more fun as we move into quarter four. Do keep an eye on US interest rates. I think these are what are really going to drive a lot of products into the last quarter of the year. It's still a feeling that the market is underpricing the chances of a Fed hike. But otherwise, keep an eye on your news tickers for geopolitical headlines as well, for particularly gold and silver. And with that, I wish you a wonderful week and fruitful trading. Thank you very much for watching. Goodbye.